right, some mortgage terms that we're going to define for you. Number one, Craig, what is a GFE?
GFE.
A GFE.
GFE. Good faith estimate, folks. That's a required document that a lender has to provide you. If you give them a certain amount of information, we won't go into all the details, but there's certain things that if you provide, namely address and social security number and all that kind of stuff, that they would need to work up a quote. They have to provide you this good faith estimate to tell you what they can do for you within a certain number of days, 3 days.
HUD 1.
HUD 1's a settlement statement.
HUD.
Exactly. HUD 1 is a settlement statement. That's the required document for closing on a piece of real estate. Whether you pay cash or finance, you go to a title company, they're going to have a HUD 1 statement.
All right. DTI.
Debt to income ratio, super big one for qualifying folks. This is the amount of debt you have factored into your income. So it's the ratio of your debt to income, and it is a set requirement that you be within certain limits or you can't get a loan.
Exactly. And folks, I want to make sure you understand, it doesn't matter what the qualifying DTI is. What matters is that you can afford that payment after you consider all you need to move your life forward. Enough savings, enough in retirement account, enough cushion, all those things. So don't get hung up on a percentage. Get hung up on how it factors into your financial plan. LTV.
Loan to value. So this is another ratio, the ratio of what you're borrowing versus the value of what you're borrowing against. So your home's worth X, you're borrowing X, there's a percentage there, and there's limitations on those as well.
CLTV.
And that's combined loan to value. Sometimes you're going to have a first and a second mortgage, and maybe even a third. So if there's any other financing secondary to the primary mortgage, that's factored in on top of what you owe on the first mortgage to come up with a combined loan to value.
This is fun. It's like a quiz. You're doing really good, Craig. Nice
Thanks,
work,
Mark.
buddy.
I've done this one
So, folks,
twice.
when I put 10% down, often you'll hear your lender say, "Oh, that's a 90% LTV, loan to value." Let's see some others that might be interesting. PMI or MIP. They are similar but different.
Similar, different. Yeah, private mortgage insurance is mortgage insurance that's paid by the borrower or potentially the lender. There's different types of mortgage insurance, but this is typically on a conventional loan provided through a private insurance entity. And then mortgage insurance premium is the more proper term for government-sponsored mortgage insurance premiums.
All right, HELOC.
Home equity line of credit. People were really familiar with these several years ago. Everybody had a HELOC now, not so much, but they're out there still. Home equity line of credit is a second lien usually against your home, although it can be a first lien, and it works like a credit card except it's secured with your home.
ARM.
Adjustable rate mortgage. That's a mortgage that's going to have a fixed period and then an adjustment period. Usually those are fixed anywhere from 3 years, 5 years, 7 years, up to 10 years, and then they can adjust. Almost always amortized on a 30-year term.
Index.
An index is what's used when calculating the rate on an adjustable rate mortgage. So there's an index plus a margin. The index is usually LIBOR, but that's the London Interbank Offered Rate while we're doing terminology. But there's other indexes as well, indices I should say as well.
All right, folks, so these are just some of the basic terminology, some of the acronyms we picked on here, or we selected here. Bottom line is, you got to work with someone that you trust that's going to take you through, educate you on these, but it never hurts to be a savvy, sophisticated consumer yourself, or sumer yourself. Thanks for hanging out with us. It's been another installment of Life as You Own It. Remember to...
stay classy.